want to welcome you all to this panel. We have a rock star panel here talking about capital and how it's accessible to emerging brands. Is that important to anyone in here? Nobody? We're going to talk about not just money, but intellectual capital, expertise that you may or may not have in your organizations, and what the timing of those things are. Before we get started, can I just get in the room, how many franchisors in this room have over 100 units? Under 15. How about between 20 and 100? And less than 20. Okay? And how many people in here have not yet started franchising, but you're here learning about it? Just a couple. Paul. See, Rocky raises it. All right. So with us knowing that, it helps us guide the questions to the group. My name's Ron Feldman. I've been lending in my career for most of my career. You probably know me that way. I'm also involved in doing some franchise consulting now, and I'm here with Diversified Royalty Corp, which when you get to 4 million in EBITDA, we'll have a conversation. Remember that now. I'd like each of our panelists to just take a minute, introduce yourself, where you're from, and then we'll get into the questions.
Hi, everybody. I'm Tony Zaccario, President and CEO of Stretch Zone. Currently 320 locations nationwide, based out of Fort Lauderdale.
Good afternoon, everyone. I'm Chris Grandpre. I serve as non-executive chairman of a company called Empower Brands. It's a family of 11 commercial and residential service businesses that produce about $1.5 billion in aggregate sales. Previously, I was the founder and CEO of Outdoor Living Brands that became part of the Empower Brands platform with our help here of our friends at Boxwood. And I also serve as an operating partner with a private equity firm, MidOcean Partners, that is the investor now behind Empower Brands, helping them invest across the franchise sector. Pat?
Good afternoon. Pat Galleher with Boxwood Partners. We are an investment bank focused on the franchise space. We've done several deals, actually more than several, but we've helped many in this room and currently helping many in this room raise capital or find a private equity partner or bring in expertise to the franchise system to help them grow. So look forward to hopefully leaving everyone with some words of wisdom.
Hello, my name is Anthony Polazzi. I'm the president and CEO of AP Franchise Concepts, which is a business that invests in emerging concepts, typically between about 5 and 20 units, and then helps them grow and expand, providing capital and expertise. And then I'm also involved in kind of a new journey as a franchisee. Through one of our platforms, we just signed a 10-unit deal to expand Zoom Room in South Florida.
Great. So we have a very, very qualified group up here, and we're going to jump right in with some questions. First question is, for you, you have to do a little bit of self-reflection. Do you need outside capital? Do you need outside expertise? Some of you do, and some of you don't. The next Peter Cancro or Shelley Sun might be out here in the room. If you don't know who those two people are, you want to Google them. What are some of the indicators that the group here should look at and do in that self-reflection to say, do I need outside capital, whether it's intellectual, cash, or expertise? And let's start with you, Tony.
Yeah, I think the one thing, and we had great conversations about this when setting up this panel, I think there's a lot of ways to be successful and find success. And I think for all the young franchisors in here, I think what's publicized the most is raising capital from the get-go, and the idea is it makes life easier and it makes growth quicker, and it can provide you with the right strategic partners, and it can. I think also conversely is there's also a way to grow your business organically and focusing on franchising the right way, and so for us at Stretch Zone, with the help of Boxwood, there you go, Pat. We didn't take on a strategic partner and go through a process till we had 270 locations. So we grew completely organically from 0 to 270 open doors. And I think ultimately, the indicators of understanding when you need to bring on outside capital, whether it's actual capital or intellectual capital, is really evaluating your team and your strengths. I think, where you guys can really leverage your own intellectual capital inside your teams is focusing on, the unit level economics of the business for the franchisee, and obviously the profitability of the franchisees, which is going to help you down the line when you do want to bring on a strategic partner. And so I think for a question like this, that there's a bunch of right answers, but I think it's first being very self-aware of the strengths and weaknesses of your team, primarily in the early times. I'm curious to hear the others' thoughts on this, but I think what's most critical early on is not actual capital. I would argue it's more intellectual capital, and truly the reason why we decided to bring on a strategic partner when we did is we recognize that as we approach 300 locations and growing at a rapid pace, the intellectual capital that we were able to procure on our own internal board is that we really needed people that had franchise experience, that are used to operating hundreds of locations, thousands of doors from a retail model. And so the intellectual capital piece was really why we went to market, rather than looking for actual working capital.
Chris?
Yeah, I think, Ron, you and Tony said it. It really starts with an honest self-assessment of what you're good at and what your strengths and weaknesses are. And a recognition that running a franchise business is completely different than running whatever your underlying business is, and will require a different skill set. And do you and your team have the skill set to successfully operate a franchise business? And when I started my journey into franchising, I just left investment banking where I did M&A work, and I didn't really know anything about running a franchise business. And I was fortunate enough to have a gentleman on an advisory board who didn't have an ownership stake, but had been a CEO of a franchise business, and he really took me under my wing. And so that intellectual capital that Tony referenced, that was incredibly meaningful to me to help me make that pivot in my life and career. And whether you're going as a founder from running your units to now franchising your units, that's a big pivot in the development of your business. And outside expertise, it doesn't have to be from capital. It can be through an advisory board. It can be through networking groups, events like this. But I think that intellectual capital can be as important as the financial capital.
Matt?
Great. Well, totally agree with Chris and Tony. And just from my standpoint, when we tend to see franchisors come to us, what comes across really clearly is when you're an emerging franchisor, maybe 10 units or less or 20 units or less, you want to have the capital to be able to choose the right franchisees and not choose franchisees just to get cash in the door. So when we look at the quality of franchisees, they tend to get a lot better once a franchise system gets up to 50 franchisees or 100, because the first ones tend to be taken too quickly and not vetted well enough, because when you're starting your franchise system, you need the cash. So getting the right capital in place early on is really important to allow you to pick and choose the right franchisees that you want early on in the system, because they're going to be the ones who do validation calls. They're going to be the ones that drive in unit level economics for your item 19. So, getting your capital right at the very beginning really lays the foundation to build a really successful franchise system. Too often we see, franchise systems really stall at 20 or 30 because they've reached for cash too quickly by taking in the wrong franchisees. So.
Yeah, obviously, just to add to what my colleagues here said, for me, it's a lot about kind of introspection, right? When you're under 20 units, right, which a lot of, I think, the room acknowledge they are, where do you want to be in 4 or 5 years, right? There are some people who would sit here and say, hey, I want to be that concept that's the leader in my industry, and I want to be 100+ units, and I want to grow as fast as I can, and all that stuff. Well, in order to make that happen, you're going to need outside capital, or you're going to need outside expertise. You are not going to have the ability to scale that rapidly without it, right? There's various places to get it from, but you just won't get it otherwise, right? On the other hand, there will be people who say, you know what, my 5-year plan is just to have the best possible ice cream shop that that's just amazing and serves the customer so well. And if I have 3 of them or I have 5 of them, that's totally fine with me, right? And if that's your goal, then you don't necessarily need outside capital to make that happen. I mean, there's maybe ways that outside capital can still play in that. But so a lot of it, to me, especially when you're emerging concept, is really understanding what you want out of your next 3 or 5 years and how you would go about what you're missing to make that happen, and then how you would go about getting it.
That was a great ad. And that takes me to the next question point, and it's alignment of goals. If you're going to bring in outside financial capital at an early stage of your business, you now have a partner, right? And that partner has expectations, and if their expectations don't align with yours, you're going to have a problem. And then, Lane's firm's going to get some money because you might go into some litigation. So the goal here is to not take money out of Lane's pocket, but to make sure that you stay out of those traps. So let's start with you, Tony, on this side. How do you have that meeting of the minds in the beginning to say, because the person putting the money in doesn't want 5 ice cream stores in 5 years. That's not what they want.
Right. Well, I think I know it's kind of trite to say, but you have to know what you want before you ever go and talk to a potential partner, right? You really have to know what you want, right? Not what you think the person wants to hear, right? Because if you go down that road of what you think the person wants to hear, then that creates the problems down the road. If you know what you want, there are people who look for different things in concepts, and sometimes, you might be able to find, somebody who made a lot of money in the ice cream business and just wants to be a part of a really cool ice cream, new ice cream concept or something. So there are capital providers, there are people, there are advisors, there are people in your community who will help support you. There are people for kind of whatever your goals are, right? Just, if you decide to go the route of a more traditional, institutional type partner, that will come with certain expectations. And so knowing what you want and then trying to use that to find the right type of partner for you, I think is most important. And, the clearer you are with upfront what your goals are, the easier it is to make that match in terms of a partner.
Yeah, and aligning the interests. If you're going to use brokers, or you're going to use an FSO, or you're going to use somebody else, what you don't want to have, and we had this conversation in one of our calls, you don't want to have 700 sold and 30 open. That's not good. That's not good for anybody, especially if you only have the infrastructure to open 20 a year. What are the odds of you ever getting to 700 if that happens? So, Pat, tell me a good story and a bad story about that.
Yeah.
You don't have to name names.
No. From our perspective, when we try to, one of the first conversations we have with a franchisor when we're thinking about taking them on as a client is trying to uncover what their objective is. Are they purely looking to take cash off the table? Are they looking to find a partner to help them grow better or faster? Are they looking to expand and become an aggregator of multiple franchisors across different verticals? So we really try to dig deep and understand what they're trying to achieve or what their core objective is. So when we set up, when we go to market and try to figure out which private equity firms or where they might fit best, we have a good idea of what our client's objective is long term. On the bad side of you really need to decide whether an FSO is right for your brand or whether keeping FranDev internally provides you better control or better access to the right franchisees versus having an FSO involved. I'm a big fan of FSOs. I think they provide a great service for young franchisors to expand faster. Only after you've got your item 19 straight, you've got all your FDD straight, making sure that you've had a firm like Lane put together your docs correctly, you've really focused on unit level economics of all your franchisees first before you really put the foot on the gas pedal and expand the number of locations and using an FSO. So, really making sure you kind of do everything in the right steps So when you do go to market and try to find that partner, you've kind of developed your objectives and you know where you want to go over the next 3 to 5 years.
Yeah, Ron, I think when you asked about alignment between a partner and a founder or a leadership team at a franchise company, I think part of the value of a process is that you are exposed to different types of investors who think differently, act differently, see the world differently, have different cultures, have different bases of experience from which they can draw upon on your board, and exposing yourself to different styles of investors through a process is really healthy. And taking the time to have deep conversations with them, to have conversations with leaders in the portfolio companies that are currently part of their portfolio or that they've recently executed, to see what's their style, how do they work with the portfolio day in, day out, what can you expect as the owner of a business, as a CEO post-close. What kind of support will you get in good times? What kind of pressure will you get in tough times? And really, I think, take the time to have the communication and do your homework so that when you pick your partner, you're maximizing the chance. There's no guarantees, but you're maximizing the chance that there's good alignment if you've had strong, open communications and you've run a thorough process.
So Tony, you recently took on a partner. Mm-hmm. How has your life changed as a CEO?
Yeah, I think it's been great. We went through a really robust process with Boxwood, and for us, for me as a CEO in my seat, I think when we're evaluating partners, is being upfront, honest with the current state of the business, what you're expecting of them after the fact, and I think Chris touched on this. What Jordan, who's the founder and my partner at the time, what we were looking for is. Every partnership is great when it's rainbows and sunshine, but really what we were looking for is the partners, when the bullets are flying and you're in the foxhole and, things aren't going to be as pretty and hunky-dory, who's going to ride that out with you and who's going to be able to provide maybe the expertise that's going to help you through those tough times. And I think that's really important when looking for a partner. And, to kind of piggyback off and dovetail off of what they were saying as far as when evaluating the right partner, what's a good growth rate. I think for most of the franchisors in here, and so in quick show of hands, how many have 50 or less units? Pretty much most of the room. One of the things, guys, that I gotta recommend, and this is going to be important when you do look for a partner, you do look for an exit to bring on capital. You've got to understand that you are successful when your franchisees are successful. Period. First and foremost. And the reason why I talk about that, why it's so important, is. Down the line, people like all three of you guys, when you guys evaluate a franchisor, are going to look at the economics and the profitability of the franchisee. If you want to sell more franchises, you want your franchisees to be profitable because they're going to be your validators early on. I think where people get misguided, and these conferences are great, and you touched on as far as like finding intellectual capital, these conferences are great because a lot of times you don't necessarily need to give up valuable equity to find intellectual capital earlier on, right? You can learn from people who have done it in conferences and seminars like these. But the bigger piece is, I think where people get misguided, especially emerging brands like yourselves, is I remember sitting in these conferences and everyone talks about franchise sales, franchise sales, franchise sales, franchise sales. And it's important, right? Because it's the lifeblood of your business early on. But at the same time, if you haven't honed in the unit level economics, if you haven't honed in the business that you're actually selling, you can sell as many franchises as you want, but you're setting yourself up for a tricky path down the road, especially if you are ever looking to bring on a strategic partner, bring on any outside capital or institutional investors.
Yeah, that's so true. That's the whole, sold, what's the healthy sold not open to what you can actually open ratio every year? How quickly should you get that to zero or keep it at a safe number? And it's different for every brand. It comes down to your ability to open a unit. I was talking to my friends at Jersey Mike's this week, and they're going to open 300 restaurants this year. And they all open on the same day of the week. That's part of their mantra. So think about the logistics of building and opening 300 restaurants in 1 year. And that's a company that's still owned 100% by the guy who started it in high school. So it is possible to do it without partners. It's usually a lot faster and easier to do it with partners. So let's talk about, we talk about unit level economics. I mean, I think I've been in 3 sessions or 4 sessions today. I think it was brought up in every one. if you don't know your unit level economics, if your franchisees aren't transmitting their P&Ls to you, you're not doing things the way that an investor is going to want to see your business. You're getting paid on top line sales, but your franchisees stay open based on bottom line earnings, right? So you want to make sure you're doing all those things right. Let's talk about platforms for a minute. We had a conversation about that, you know, and Chris, you're part of a platform. When a founder sells into a platform, let's talk about the psychology of it. What happens?
Yeah, in our construct at Empower Brands, I think we have purchased a number of founder-based businesses, and the dynamic has been the founder wants to stay focused on running the underlying business, and they stay on with us as the brand president to lead and guide and drive that franchise business forward. But what they get access to as part of the platform is the shared services teams and the infrastructure that we've put in place, the franchise development engine, the HR department, the finance and accounting, the marketing and the lead gen focus and driving of the brand funds, the technology group. We have invested in a infrastructure base that supports the 11 brands across the portfolio. So the founder, in comparison, if they were directly invested in by a PE firm and they were going to be the platform, they're able to stay focused on their business. Whereas if you become the platform, suddenly you're spending your time thinking about strategy, thinking about M&A, thinking about upgrading your leadership team, upgrading your financial reporting. You're going to be pulled away from the underlying franchise system that you're driving today. In a platform, the founders have gotten to stay focused on driving the growth in the business that they know and love, and then they tap into the resources of the platform.
And psychologically, they go from being the employer who has the goal to the employee where someone else has the goal. So,
other than I would say, in every case, founders have become meaningful equity owners in the platform. So there's a personal diversification that happens where they're taking some chips off the table, and that's important in every transaction. I know we talk a lot about alignment and culture, and that stuff's critically important. So are the financial sides of equations, right? They are to all of us. So in most cases, the founders have been able to de-risk, take some chips off the table, but also roll into the equity of the platform so they have an ownership stake in the go-forward entity, and it's in a larger, more diversified company that may well trade at a larger multiple whenever there's a secondary exit event.
So all platforms are not equal. That's a great structure. I won't name them, but there's a bunch that aren't.
I was actually just about to say what Chris said. To our clients, it becomes a big benefit, that personal diversification of taking 100% of their risk on one franchisor and then rolling a rollover stake into a platform of 5, 6, 10, 11 franchisors. And as Chris said, the multiple expands higher, better use of leverage, better shared resources. We've been very successful as a firm selling franchisors into platforms. And one other thing is when you run a process, you get to interview 5 or 6 platforms to see which one you think you would fit personally better with. The culture fits better with you. And I know that when we've sold franchisors to Chris and the team at MidOcean, that's been a big factor in them winning the deal versus somebody else. Is at the management meetings, they've felt very comfortable with the culture and the strategy that Chris has developed at Empower with Scott and the team. So it becomes a big factor in it's not just purely the highest dollar value that drives where our clients pick a partner. It's some of the softer things around the platforms that they choose. So.
Yeah, and I was just going to comment. I mean, this again goes to knowing what your goals are for you personally, for your business. Platforms are fantastic things because the leverage it gives you, the diversification, all the things that they mentioned, but then you're no longer a pure play in your business anymore, right? So that's the flip side of that coin, right? If you want to be like we own a dog training business. I'm a minority owner in a dog training business called Zoom Room that's got, about 130 units that are sold and about 54 open. and our CEO, he wants to own dog training. He wants to be the dog, training business in the world. And, that can't, if we join a pet platform, right, then he's just part of a pet business overall. He's not the leading dog training business in the world. And so there is, it depends on what your goals are, and that's why it's important to kind of define those before you go and look. Or, talk to some experts like Pat, and they'll help you kind of work through what the benefits of each of those things are, and where you go. But it's very important before, because, the economics can look very good, but ultimately you might end up being unsatisfied if that wasn't really where your goal wanted to take you.
And that's one of the beauties of the franchise ecosystem. Everyone says industry, and it's one of my pet peeves. It's not an industry, it's a lot of industries. But people in franchising share. I can't tell you how many panels I've been on where two competing CEOs are on the same panel, and they're telling their secrets out to other people just to try to pay it forward. So intellectual capital is something that you don't necessarily have to give away equity for. You maybe don't even have to give away money. You might give away a meal or two or a bottle of scotch, but lean on the people that are here that have already been there. That's what Springboard's all about. We have 7.5 minutes left. I want to open it up to questions.
Yeah, I was wondering if you could actually speak to how your criteria for evaluating candidates to invest in has changed, particularly pre-COVID, post-COVID.
I think, I'm not sure it's changed so much. I think at the top of the list, as Tony alluded to earlier, it starts with the unit level economics of the system. And it's unit level economics is not really a driver of valuation from our perspective, putting my MidOcean hat on or even my Empower Brands hat on. It's a gating issue. If the ULEs aren't strong, they aren't consistent, they aren't improving by cohort, then there's probably a no-go decision for us. So it starts with ULEs, and then I think right behind that are things like the franchise ramp as you're bringing on new units. Is there a consistency of ramp of those new units toward the system AUV? Has that been improving by cohort, showing that you as a franchisor are getting more and more adept at finding the right franchisees, onboarding and training them and ramping them up to your system averages, and is that improving over time? So, there's a bunch of things on the criteria, but those two issues, ULEs, ramp, payback, are going to be at the absolute top. And maybe the tertiary one for us is the composition of EBITDA itself. All EBITDA is not equal. If your EBITDA is driven by initial franchise development fees, company store platforms versus recurring royalty-based revenue, it's simply not going to be valued at the same level as true recurring franchise royalty-based revenue streams. So those are probably the three top ones for us.
What's the four-letter word that all of that equates to? Begins with a D and ends in an A. Data, right? If you're not collecting it, I said it before, if it's one thing you leave with today, it's get the P&Ls and know what your franchisees are doing, and make sure that they're segregating their kids' tuition and their boat payment and all those things outside of the P&L they're submitting to you as cost of goods sold.
Yeah, just real quick, the only thing that we would comment on that is right at the top of our list is the partner. We spend a lot of time making sure that that the partner is the right fit from our standpoint. So that's, that would actually be number one even before unit economics for us.
What are some of the softer deal aspects that create value? And I'll ask you, Pat.
Yeah, I mean, some of the softer things. I mean, we've kind of beaten the horse on unit level economics, which I totally agree with. I mean, that's
let's keep beating it.
Yeah,
it's
no.
what matters.
I mean, when a franchisor approaches us and starts talking to us and giving us information about representing them, it's what we dig into. I mean, we dig into, are your franchisees healthy? Are they buying more locations? Are they buying more territories? And what does your item 19 look like? And, we stress test the item 19s and pretty hard before we take on a client to make sure the numbers are right. The softer things are really, are you building a brand? Do you have true differentiation in the marketplace, or are you just the second blinds company or the second mosquito company, or are you just selling territories in an already sold out territory through an FSO? So, we really look at the softer aspects of the franchisor, how they're building the brand, how the founder interacts with their franchisees. All those things end up driving value at the end of the day, because all the private equity firms are going to do diligence at that. They're all going to look at that. They want to know that they're buying into a leadership team, a brand that truly can take 100 units and turn them into 1,000 units. And you can't do that unless you have the right foundation, the right franchisees. And it goes back to that validation. Getting the right franchisees on the bus early on is the biggest issue we see with franchisors when they get to 100 units. The first 20 locations they sold just to get cash in the door. So you really need to make sure as you map out your journey to 100 locations or 200 locations, that you build that base correctly and you get the right people in the system early on. I mean, as Chris said, franchise fee income, no one pays a multiple of franchise fee income. That's one time. We're really looking at the ramp, the curve of royalties, and how that's going to grow over the next 2-3 years, and just getting the right franchisees on the bus. And I think many of you have seen the same locations, same territories make vastly different money based on how good that Z is running that territory. So you got to interview your potential Zs and think about them as employees, and think about who's going to make you more money and help you build your franchisor. So don't take the quick dollar just to add cash to the bottom line and sell a great territory and have it underperform for years. So.
The first item that, and I won't make a bet because maybe we all have different styles, but the first item I ever look at in an FDD, and I've probably read 3,000 FDDs, is item 20. I don't look at item 19. Because what's closing is more important to me as a debt lender to franchisees. If a unit closes, I can't get repaid. Much the same way, your royalty stream ends when a unit closes. So that churn is really important. So I'll ask Tony, you were around from day one? Yep. Of the first 30 units you opened, how many closed?
We've yet to have a closure. So my message to everyone in here is that you guys, at your stages for both 50 and under, you cannot afford to have a single franchisee fail.
That was not rehearsed.
And no.
We did not discuss that on the call.
But that's so critical to where, and I think the craftiness of your leadership team is in the early days, and that does not mean all of our early franchisees were successful and stud and A players, right? There's a lot of people that, quite frankly, and just being honest, we approved that probably would never approve again. But like Pat says, and everyone in this room, you're going to hear throughout the entire conference, is you're going to hear, make sure you bring on the right franchisees. Don't just take the franchise fee. Well, listen, that's easier said than done when payroll is X, right, and rent is this, and all of a sudden you have this franchise owner who wants to do 2 stores, early adopter. But we were really crafty as a leadership team because we understood our business so well that in the early days, and communication is really, really important, having an open line of communication. One thing Shannon Hudson said, which I completely agree about, and my team always is surprised by this, my cell phone is available to every single franchisee and always has been, and I always make it a point to reach out and respond back to a franchisee. And I'm saying that for emerging brands. You guys have got to be able to sniff out a problem before it becomes a major issue or a potential closure. And where I'm saying you guys got to be crafty enough to go ahead and address these issues before it puts the location in a position that it can't recover from. So as far as item 20, no. Dan, we keep our item 20 nice and clean, don't we? Yeah, so, yeah.
And with that, we are out of time. Thank you, everyone. Enjoy the rest of the conference. Don't let any